Why does your cash feel like it's losing value every day? Welcome to the fiat problem. In the next 10 minutes or so, we're going to break down how the machine behind the scenes is quietly taxing your savings without your consent. First, we got the Federal Reserve. Every single month, the Fed pumps roughly 120 billion of fresh money into the system, into the machine, keeps it going, and they call it their quantitative easing policy. Listen, that's 120 billion that didn't exist before. And now every dollar you hold is a little less valuable. Meanwhile, Congress keeps spending. When they outspend tax revenues, the Treasury issues bonds to cover the gap. Those bonds get snapped up by big banks, institutional savers, investors, and foreign governments. Sweet deals for them, but more obligations for the unconsented taxpayers. And here's where it gets truly unfair. When a major bank gets in trouble, it often receives a bailout, kind of like a raft funded by your tax dollars. But ordinary savers, like yourself, well, we watch helplessly as our purchasing power erodes without our consent. On average, cash loses over 4% of its purchasing power every year. That means $100 today buys you just $96 of the goods that you could have bought today a year from now. Now, I don't know about you, but that's definitely a terrible deal. Who signed us up for that? It's tough to say. You might be earning 3% interest on your savings account, but with inflation eating up more than 4%, your real yield is negative. So in other words, you're down about 1%, all while prices for groceries, rent, and gas climb higher. This silent thief is called the inflation tax. You never voted for it. You never consented to it. Yet every dollar you've worked for is quietly being diluted behind your back. Here's the chain reaction. We have the Fed, who prints 120 billion monthly, causing the money supply to rise, causing each existing dollar to become worth just a little bit less. And then that causes savers who earn negative real returns, and leading to finally the invisible inflation tax taking its toll on your saved money. So what can you do? Listen, recognize that cash sitting idly in a bank is losing value. Explore alternatives, such as equities, real estates, or other strategies that outpace inflation. Don't let the Fed's printing press turn your hard-earned dollars into dust. While you're sitting back looking pretty, trusting the big banks when they tell you, hey, you're earning 4%, you're earning 3% on your money and your savings here. No, that's not true at all, and they know it too, because they're borrowing against your funds and money that you saved with them as well. So you're getting double the dose there. While they're finding value in your savings and putting it in equities, you're trusting the government who's printing against your value. Moving on, let's take a look at how the MicroStrategy business intelligence firm is hedging against the risk of inflation. Now picture this. The scene is July 2020. We're inside of a boardroom in Virginia. CEO Michael Saylor stands before MicroStrategy's board with one bold proposal. Now, he wasn't pitching new software features. He wasn't talking about margins or enterprise deals. He said with a straight face, we should use our corporate treasury to buy Bitcoin. Now, Saylor argued that Bitcoin is scarce, digital, and permissionless. And that was the ultimate hedge against inflation and the US dollar's devaluation. With the Fed printing trillions of dollars in response to the pandemic, he saw fiat as a ticking time bomb for corporate balance sheets. you have fiat US dollar on your balance sheet, you're simply losing money over time due to poor management by the US Treasury and the Fed. Now, when Saylor said all this, it wasn't without conflict. It caused skeptics to cry out foul. Why gamble our cash on a volatile cryptocurrency? And, volatility is true and real. So it's fair for them to think this way. But Saylor dug in. He was not pushed back or deterred by their fear of the New World Order. So he convinced the board that the risk of doing nothing being letting cash erode in value, was far greater than the risk of volatility in the crypto market. So fast forward to August 11, 2020, Saylor gained the board's approval to allow MicroStrategy to deploy $250 million of its cash reserves to buy 21,454 Bitcoin, all due to Saylor's insistence. Now, that money purchase instantly made MicroStrategy the largest public corporate Bitcoin holder. As Bitcoin began its parabolic rise, MSTR stock followed suit. Early doubters watched in belief as the risk play turned into an institutional-grade bull run. Saylor didn't just buy Bitcoin. He wrote the blueprint for corporate treasuries everywhere. Other CEOs saw MicroStrategy's gains and thought, why are we letting our cash sit idle to lose value by something we can't control? So by late 2021, heavyweights like Tesla and Block and even other major hedge funds were scrambling to jump in on the Bitcoin freight train before it left the station. In August 2022, Saylor stepped down as the CEO to become executive chairman, solely to double down on Bitcoin strategy. He knew his mission wasn't writing code or chasing new clients, but steering a Bitcoin revolution from the boardroom. And from a BI software boss to Bitcoin pioneer, Michael Saylor turned a simple treasury move into a corporate movement. He proved that in an era of finite, or rather infinite money printing, holding cash is the real risk. So you must be wondering, now that Saylor has gained the board's approval to steer MicroStrategy in a new age direction, how does it work? Well, the strategy itself, it's called the Bitcoin Flywheel. And this is MicroStrategy's self-reinforcing strategy that turned balance sheet moves into market momentum. In the next few minutes here, we're going to talk about and walk through the 4 steps of this cycle and show you how both institutions and retail investors like yourself can apply to this. Sit back. All right, so the first step we have here is raise fresh US dollars without touching core assets. Now, the institutional player will go about this a little bit differently than the retail. For them, they're able to issue debt such as convertible senior notes, secure low interest loans, or sells equity. And MicroStrategy, they unlocked billions using these tools, as it allowed them to preserve their existing software business while freeing up capital. For the retail, you can mimic this by tapping cash savings, automating dollar cost average contributions, or carefully using small margin lines. The goal? Gather enough dry powder to make your first Bitcoin strike. And this leads us to the second step, right? You've got that cash. Now what's next? Well, in step 2, it involves converting that cash into Bitcoin. And you're going to see institutions such as MicroStrategy executing large over-the-counter block trades to minimize slippage and secure their position at the best possible price. While the retail side, they head to a reputable exchange, right, such as your Robinhood, your Coinbase, and set limit orders or automate recurring buys to smooth out volatility over time. Consistency is key, That's why you should look into dollar cost average. Step 3. Now you've accumulated your Bitcoin treasury to a sufficient level, maybe 1 to 5% of your overall market value. And now you're on to step 3. You sit back and allow the market to do its thing and watch as the price of Bitcoin goes flying. Now it can go down now. It is an investment. No one can truly predict where the price will go. But think of it this way. As Bitcoin's fixed supply narrative and growing adoption drive news cycles and retail speculation, its price is going to shoot upward, right? Because everybody is now going to want to get a piece of a pie that is getting significantly smaller over time. Some might even argue at an exponential rate. And so corporate tickers with significant BTC exposure, like MSTR, they tend to rally in lockstep. And for the retail investor, this price action sparks a broader FOMO, fear of missing out. And suddenly now you got your friends and family asking, how do I get some of that? Well, this is going to create a positive feedback loop that funnels in more inflows, lifting the tide for all Bitcoin holders. Now on to step 4, reinvest and compound. Compound interest is the 8th wonder in the world. And for the institutional side, it's going to look like this. With MSTR's share price up, MicroStrategy can now return to the capital markets, issuing new debt or equity at even more favorable terms than before. And that's going to flow in fresh dollar USD that then they can use to buy more Bitcoin, restarting the cycle at a larger scale than before, compounding their gains on gains. And for the retail investor, you've booked in your profit from earlier buys. Well, you can reallocate those gains into new Bitcoin purchases, etc. Yet, having dollar cost average over time into Bitcoin, you should really be looking to hold on to any amount long term, and maybe even rebalance and take gains as time goes on. But overall, that's the power of dollar cost averaging and compound interest. So there you have it. Step 1, raise USD. Step 2, buy Bitcoin. Step 3, watch the market boost your exposure. Step 4, reinvest and compound. That's the Bitcoin flywheel in action. A strategy that takes you from capital raise all the way to self-reinforcing growth, which in turn only serves to empower you on your growth journey. So if you're ready to kickstart your own flywheel, whether you're running a Fortune 500 balance sheet or building your personal portfolio, the principles remain the same. Raise capital smartly, buy Bitcoin with conviction, ride the momentum, and reinvest to compound your gains. Hit like if you found this helpful. Subscribe for more crypto breakouts and ring the bell to stay ahead of the next financial innovation.